Tree Group, connecting people, building communities, helping clients to build multi-generational wealth through real estate.
What's going on, guys? My name is Vlad. I'm a part of the Purple Tree Real Estate Group in Toronto, Ontario. And today we have a podcast with a fantastic guest, an accountant from the city of Toronto. This is definitely a relevant topic given the tax season that we're in. We're in 2023. We're at the end of March, so there is about 6 weeks remaining before the filing deadline for individuals. We're going to answer questions that we often hear from our clients. We're going to ask those questions and hear the answers from the expert. But for right now, we're just going to go around the room and introduce ourselves. My name is Vlad again. I'm with Purple Tree Real Estate Group.
And my name is Mitra with Purple Tree Group Real Estate. We are privileged to have Norman Pulker with us today, who's been my personal accountant for over a decade. And Norman, can you tell us more about you?
Well, first of all, thank you very much, Mitra and Vlad, for having me on. I love to get the tax word out, the good or the bad. I'm Norman Pulker with Horizon Tax Services. We do about 1,000 personal tax, 100 corporations, including businesses and rentals.
That's great. So, Norman, now that you are here, there are several questions that our clients are constantly asking us. We thought that would be a great opportunity that we would address some of them. And the first question, we know that every year CRA changes certain things, some good and some not that good. Can you tell us more about that?
So we'll start with a not so good subject. It's very interesting, as CRA's trying to figure out how to catch people who flip properties and tax them as a business versus a capital gain, which pretty much doubles the amount of tax that you're going to have to pay. So flippers are defined, the rules aren't 100% defined, but it's if you own a property for less than a year, and the type of person you are, whether you're a realtor or business, and if you're making money on selling properties. So then CRA could deem you to be in business, and when you sell, it's not a capital gain, which is only taxed at 50%. It's considered business income, and it's taxed at your marginal tax bracket, and it could hurt. So something to be very aware of in how you handle purchases of property. That's sort of on the not so good side. There's some interesting things also related to real estate. The change this year is CRA's doubled the amount for the first-time homebuyers tax credit. It was $5,000 as a non-refundable tax credit. Now it's $10,000, which translates into a tax savings of $1,500 on your personal tax return.
That's for 1 year only?
And it's first-time home buyers, which are defined by somebody who has not owned a property in the last 5 years. And it's only good for the first time that you file after you own the property. A couple of other things that are new too is the home accessibility tax credit, which allows you to do renovations to allow people to stay in their homes, like widened doors, lower counters. So this is for people that are over 65 that are disabled, have the disability tax credit on file. We'll talk a little bit more about that later. And the other thing which is really new and very exciting, getting the word out about tradespeople that have to work more than 150 kilometers away from their home now can write off up to $4,000 of their accommodation expenses in the place where they're working. And that'll save them, $1,000, $1,500, maybe up to closer to $2,000, depending on how much money they do make, what their marginal tax bracket is. So that's something new. It doesn't say it's going to come out. It's not like the Ontario staycation tax credit, which is only good for 1 year only. And we'll talk a little bit about that later too.
So we are going to go more in details about each of them, of course. We also hear a lot of questions about rental properties. Can you tell us more about it, relationship with capital gain, capital loss, and anything in between?
Sure. Rentals, we see a fair amount of rentals, and you get the renting part of one's principal residence out versus you get the 100% rental, like a separate detached house or condo or something that's 100% rented. So looking first at renting out part of your house, we always make sure that never rent out more than 50%, or you never claim more than 50% of your principal residence as a rental, because if you do more than 50%, it's deemed to be a change of use, and your principal residence then could be subject to capital gains. And it's either it is a principal residence or it's not. It's not based on the amount that you rent. So when you rent your personal residence, a piece of it, the basement or something, you are allowed to write off approximately, or based on the square footage, you can prorate the amount of square footage that you use for rental versus in the whole house. So you get to write off things like interest on the mortgage, property taxes, insurance, utilities. But once again, it's prorated on the amount of space that you use. Versus 100% rental, then you can write off anything that you end up paying. It could be property taxes, insurance. The biggie, of course, is interest on the mortgage, not the whole mortgage payment, just the interest on the mortgage. Now, the issue comes when you turn and sell the rental property. It's considered a capital gain on what you paid for it, plus any major renovations or costs you've done to improve the property. Then you subtract what you sold it for and the costs of the sale, i.e. lawyer's fees or realtor fees, and then you look at the difference, and if it's positive, it's considered a capital gain, and half of that will be taxed. Not half is tax, it's half of the capital gain is at your marginal tax bracket. If you happen to sell at a loss, unfortunate with these times, then you're deemed to have or considered to have a capital loss. And capital losses can only be applied against capital gains from the past or in the future. So rentals we always hope for a positive cash flow, which is a little harder now with interest rates the way they are. So that's, I think, about it for rental properties. If you have any questions, you know who to be in touch with.
Yeah.
That's great. So I have a couple of questions. So if there is a negative cash flow, then that would be factored as part of the tax refund?
Yeah, if you have on a rental, if you have a negative or you have a loss, it can be applied against other income. Always has to be reasonable and not excessive, but it can help reduce the tax burden. However, you have to be responsible for some income tax. If you're a low income earner, it won't make any difference. However, most people who own property are responsible for some income tax. So therefore, a loss can be applied against their other sources of income.
Perfect. What if somebody has a rental property and at one point they decide to reside and it becomes primary residence? So what would be the rules around that?
That's a challenging, interesting question, and people are misinformed slightly about it. So when you have 100% rental and you decide you want to move into it, it's now a deemed change of use. So it now changes from a business, a rental property, to a principal residence. So we have to take a look at a capital gain on when you bought the rental property, same thing about any improvements, and then the date that you moved in is now the date that there's a change of use. So we have to do a capital gain from when you bought it to that date, and then it becomes your principal residence and no capital gains will apply.
Okay.
Actually, I have a quick question. I have a client, just wanted to give you a scenario. We have a client that purchased the property a long time ago, like 15, 16 years ago, say for $300,000 for the argument's sake. Over the years, the property has increased in value, and now say the value of the home is $1 million. The property requires renovation. It's tenanted at this point. And, they're thinking, should they renovate? Should they sell as is? What are the venues to mitigate the impact of potential taxation, right? Specifically the capital gains taxes when they sell. Are there any ways that they can minimize that? What can they explore? Does it make sense for them to actually renovate the property and spend the money there because they're going to increase the value and possibly increase the margins and therefore the taxable amounts that they owe to the CRA? So what would you recommend in this case?
It's a real life scenario. So when people, it's 100% rental property, it will be subject to capital gains when it's either sold or there's a deemed disposition. Now, renovation costs get added on to the cost of the property, what you paid for it. When you buy a property, there's of course some lawyer's fees and there's lawyer's fees and whatnot. So they get added to what they call the adjusted cost base. Any renovations and improvements to the property are also added to the value of the property when you buy it. So then you turn around and when you sell it, you've got to look at your adjusted cost base, which is what you paid for it, and all the costs that you've put into the property, and then you take a look at what it sells for, and the difference is subject to capital gains. Whether you do the renovation, it probably increases the value more than what the renovation is. So from the tax standpoint, or from the personal standpoint, you've made more money. And yes, the tax man takes a little bit more of it, but you're still ahead of the game.
Okay.
So in reality, you would renovate, and if you want to sell, then you are going to pay more taxes, and perhaps it's better not to renovate and come to the market without the renovation. That's what you are saying?
Not quite. If your house is worth $1 million now, you paid $300,000 for it, it's worth $1 million now, and you want to put $100,000 of renovations into it. So now it's 1.1, and you're going to sell it for 1.2. So you've put 100,000 in, you're going to make an additional 100,000 in capital gain, because now that 100,000 is translated into 200,000. So you're always further ahead. Yes, the taxman will take a piece, but you're still making more money. If you're at the 30% tax bracket, then that 100,000, of course, with capital gains, only half of that's taxed. So then 30% of 50,000 is $15,000. So you're putting, 100,000 in, you're going to make an additional capital gain of 100,000, of which you're going to pay 15,000 on tax. So you're always ahead of the tax man. It just hurts a little bit.
Gotcha. So actually, Mitra, just wanted to ask another question as a follow-up to the previous one. I'm curious if there are any special programs that would allow, say, a homeowner to say, okay, I'm going to rebuild this house and make the new structure purpose-built for affordable housing, just as an example, right? Would that have an impact, a positive impact on having to pay the tax at the end of the day, or it's going to be just the same?
That's a loaded question, because change of use, and then now we've got another change of use. From the tax standpoint, I don't see any advantages to that, but there may be through the municipal or provincial or federal, there may be a bunch of grants and whatnot available if you're going to move it into an accessible house for other people. We can talk about the accessibility tax credit as well, but that's another subject. But in that regard, if there's something, there might be something available through the province or the feds if you want to do something like that. But from the tax
mixed use.
Yeah, from the tax standpoint, there is no advantage.
Okay. So one other question.
Yes.
Actually,
okay.
One other question with regards to that. I'm curious if there are any, again, if you know, if there are any tax abatement programs. Like in the US, it's very widespread. You can go into a particular area, purchase a property, rehab it, and then you have a tax abatement for the next 10 years. Is there anything like that going on in Ontario or anywhere in Canada for that matter?
Very interesting that you bring up the U.S. component, because I have people come to us and say, well, I can write off interest on my mortgage. Yes. Did you Google that in the U.S. or Canada? And people, what? So there are different tax rules in different countries. And in Canada, you cannot write your interest off on a mortgage. In the U.S., you can. However, there's some capital gains impact in the U.S. when you sell your principal residence, I understand.
Not in Canada.
I'm not an expert in U.S. tax law at all, but from the Canadian standpoint, your principal residence is not subject to capital gains, but you cannot write off the interest either. There's been some rumblings that the feds may do that. So coming back to your question, though, I'm not aware of any programs from the income tax standpoint for that type of thing. Once again, it would be your MP, your MPP, and even your municipality may have some programs available, tax grants and whatnot. And of course, there's lots of hoops to go through with building permits and and inspections and whatnot, but that's just sort of my knowledge, nothing to do with taxes.
Imagine how we're going to increase the number of phone calls to MPs and MPPs after this podcast really blows up and explodes.
Purple Tree Crew, connecting people, building communities, helping clients to build multi-generational wealth through real estate.